let's actually bring on board Vinnii, who was actually covering up while I was on leave, to talk especially about the space that she covers very closely, and that is the QSR space. Vinnii, what's exactly happening in that particular counter? Give us a lowdown, because a lot of earnings have also come in for the space, and how are the stocks performing?
So absolutely, we have all those QSR names which have reported their numbers. It had been a very exciting week in terms for the QSR space, because there's a clear trend that has shaped up now, and that we were talking about is that, you know, pizzas, the demand for pizzas maybe has been more subdued. The impact for companies which are making pizzas was more because of the prices of milk and cheese prices that have been quite elevated. So let me just take you through a breakdown of how the numbers were. Jubilant Foodworks reported an inline set of numbers, but the like-for-like growth which they gave, which is instead of the SSSg growth, that came in with a decline of 0.6%, and the inferred number for the same store sales growth was at negative 3%. So yes, 0.6% decline in LFL and negative 3% SSSg growth. Even when you look at Sapphire Foods, which has the KFC as well as Pizza Hut brand, clearly, KFC was doing better in terms of the SSSG growth. They saw 2% growth there, while Pizza Hut saw an SSSG decline of around 4%. Devyani International, similar trends coming in there, while KFC saw a growth of around 2% in terms of SSSG. For Pizza Hut, Devyani International's Pizza Hut SSSG was down by around 4.2%. Westlife Foodworld, good set of numbers came in from the company, and look at the SSSG growth there, same store sales growth at 14%, which is surely best among the peers as well. Restaurant brand Asia also, which is Burger King, that also saw a good growth. Operating performance was quite strong for the company as well. So clear trend that we're seeing that Pizza Hut, Domino's, there the same store sales growth has seen a decline. Even in terms of commentary for Jubilant Foodworks, they said that their near-term concerns are there because of those historic high valuations for milk and cheese, which have still continued. They could continue, so maybe margin pressure is possible even in Q1 if we go to see as well. Sapphire Food too highlighted in terms of the weak demand for the SSSG, which kept it muted because of those weak demands. Demand for discretionary has been a bit slow. And Westlife Foodworld, on the other hand, that is McDonald's, has highlighted that, you know, they're expecting margins to come back to that 18 to 20% in 2027, expecting margins to go above that 17% mark as well in FY24. So clear trend where pizza is a bit subdued in terms of demand. Burgers are doing quite well. Valuations seem to be a bit on the higher side, but that is one to watch out for, that, you know, is it an attractive time to buy into these QSR stocks? That's something that one should watch out for.
Well, thank you so much, Vinnii, for highlighting what's all happening in the QSR space, the quarter gone by, how the numbers being reported, and what kind of a commentary we are getting from the managements, wherein we see a sort of a mixed set of commentary coming in. Some highlighted that the demand could be muted, but some are also highlighting that inflation could be seen stabilizing going ahead. But the worst is behind for the QSR space, but they continue to be richly valued and may see a time-wise correction going ahead. And that's the word coming in from Nikunj Dalmia, Managing Editor, ET Now and ET Now Swadesh. Let's listen in to his take onto the QSR space.
You know, the most important number which markets looks at in order to understand the growth of the business is SSS. Yeah. The same store sales. In that, there is a lot of variable factors which really are at play. Frankly, if you ask me, Jubilant is growing. KFC, which owns, KFC, we don't need to introduce the product here. That business is growing. But in case you're wondering that why, if Indians are eating out so much, why you don't have a really strong trend in the entire QSR space, at least the listed ones. Do you want to guess that?
Why is that?
Indians are eating biryani.
None of the companies, health conscious.
None of the companies here actually are in the biryani business. They're still in the startup space. So the point I'm trying to make here is that these businesses, the QSR space, now it's almost like a basket of 4-5 names. They've gone through a patch of high inflation, solid expansion, and huge uptick which came immediately after the COVID as you were staying indoor and you were ordering more food. And inflation also has really managed to take a piece out of the pie. But worst for the sector is behind us. That is the sense which you're getting in terms of the demand, and that is the sense which you're getting in terms of commentary. The problem is that this entire basket is very richly priced in terms of valuations. 54 times for Westlife, Sapphire Foods, 48 times, all of them. Now, this is pretty much like valuations what some of the FMCG brands they are commanding. And for me, anything which is commanding valuation of FMCG stocks, if it's growing at 15-20%, it means that market's already pricing that in. You know, I think we are at the transition phase right now where you want to eat more calories rather than focusing on the health part. That is how the that is how the migration is moving in small towns as well. So I think some of these stocks, at least the QSR stocks, are looking expensive. You want to buy them, but you don't want to buy them right now. And considering where the valuations are, I guess in the near term, these stocks can go through time-wise correction as well as price-wise correction. It's a great space to be in if you've got 3, 4, 5-year view. But these are not the great stocks to buy at the current valuation.
All right, so that's the word coming in from ET Now, and ET Now's Swadesh's managing editor Nikunj Dalmia on the entire QSR space. He believes the worst is over, but the valuations still are pretty rich for all of these companies. But let's ask our